Hi, welcome to valuationpodcast.com, a podcast and video series about all things related to business and valuation. My name is Melissa Gragg, and I provide divorce mediation and valuation services in St. Louis, Missouri. Today, we'll discuss valuations for financial reporting with Mark Zyla. Mark is a valuation expert in Georgia, the managing director of Zyla Valuation Advisors, which is an Atlanta valuation and litigation consulting firm. Mark is also the chairman of the Standards Review Board for the International Valuation Standards Council. He also was the primary author of the education program of the AICPA and the Royal Institute of Chartered Surveyors for the Certified in Entity and Intangible Asset credential. This is the CEIV, which I believe most valuation professionals are aware of, that goes towards certifying valuation experts in valuation for financial reporting purposes. And it's a fairly new credential. Why would a company need a valuation for financial reporting? Like, what do those words even mean to us?
Sure. It dates back about 20 years or so ago when we had the technology boom, when companies were buying one another and paying millions and billions of dollars for stuff. And under the old accounting rules, they put it into goodwill. And so the Accounting Standards Center, the FASB, took a look at that and said, are they really buying goodwill? Are they buying something? And, as you can imagine, they're buying something. They're buying technology. They're buying domain names. They're buying customer relationships and things like that. So the FASB changed the accounting rules so that when one company buys another company, they have to identify those assets, what they actually bought, and how much they paid for them. And so on their financial statements and their balance sheet after the acquisition, they have to put the values of what they actually bought and what they paid for it. And they incorporate the acquirer incorporates it on their balance sheet. Okay,
so I'm a company and I go buy another company. Do I need to be a publicly held company? Can I be a privately held company? Do I need this for all purposes if I buy something?
Yeah, it's all purposes. So there's no big gap, little gap. If you're public or private, the same rules. However, there are some exceptions that the FASB over the years have made for private companies if they decide to elect those exceptions.
Okay. And you said another word that I think people kind of have an opinion about, but goodwill, right? Give it a little bit more. So let's say we buy a company and it's got assets of $1 million, okay? And we pay $2 million. Kind of walk me through, where does that other million go?
Sure. Yeah. If you think about it, like it's more than just what shows up on the balance sheet. So it's more than just the working capital and the fixed assets. It's intangible assets. It's a workforce, it's the employees, it's intellectual know-how. So all those, that additional value is for those specific identified intangible assets. Also, there's typically a piece left over which falls into goodwill, which is value of assets that typically isn't identified, but it might relate to the fact that these assets are combined and they're in place. You don't have to go out and recreate a company. Or things along those lines that may not be identified, but add value to the company.
Well, and I think that's, is this similar when we hear people talk about a purchase price allocation? Like, is this similar? Is this the same process?
Yeah, it's the same concept. Under the old accounting rules, it used to be referred to as a purchase price allocation. Now, it's referred now to as an acquisition method. Basically the same concept. It's that you have a business combination, you paid something for it, so you have to identify what you bought and specific assets and put it on your balance sheet.